Hello and welcome. You're watching us here on Chartbusters. This is a show where we talk about all the buzzing stocks of the day, and what's buzzing actually this morning is the market itself. A century in the first hour of trade itself, 17,900 is here. Nigel, the question is 18,000 around?
Yeah, is 18,000 around, Mangalam? It's going to be quite interesting. And, everyone's looking at the equity markets, but just a quick point on the dollar index. It went to around 110.5 odd. And from there, it's cooled down. When we started off trade today, it was at around 109.2. Right. And that's moved to around 108.8. So good to see that the dollar index has cooled off, which is normally positive from an emerging market standpoint. And the second factor is crude oil prices as well still hold below that $90 per barrel mark.
We will monitor that. The important part is that, at these levels, the FIs are still 76% short. So with all these positive cues coming in, will there be a lot more short covering or not is something that we will monitor. But remember, this is also the zone where we've retraced from in the past. With all those cues, let's talk about the top stories that we're tracking. It's a strong start for the Indian market on the back of positive global cues. The Nifty trades near 17,900, led by metals and the banking pack. Midcaps marginally outperform.
Rail Industries temporarily shuts down its European unit as energy crisis hits the operations. The company says it's in process of looking at a contingency plan in anticipation of natural gas shortages and price hikes.
PNC Infra signs an agreement with the NHAI for a 1450 crore highway project. The stock is higher by about 2%.
The management of Federal Bank tells CNBC-TV18 that there is no conversation of the bank getting merged with another. He also expects loan growth improve and net interest margins to be at around 3.25%. All right, well, a quick check on the markets then, Mangalam. We are soaring away, and the Nifty Bank, that's the one that's looking absolutely beautiful. Pull up the intraday chart out there. When you back up a 700-800 point rally with another 500 point rally, that's telling you the kind of mood that it is in. And the cement names as well, they continue to spike up. Remember, they've been relative underperformers, whether it's Ultratech Cement, whether it's Shree Cement. Year to date, those companies are still giving, I think, negative returns. But the last couple of days, the street is abuzz that consolidation is going to take place. And that's why that big theme is being played out.
Well, we're talking about individual stocks here. The Nifty Bank is just about 2.5–3% away from its all-time high. That is something we'll monitor. But in the broader markets, GSPL, that's the one stock which is up 8% this morning as we speak. Given company is Navin Fluorine, which was a big mover yesterday as well, continues its gain today, up around 2.5–3% odd. Gujarat Gas is the other one which has moved to the high point of trade as well. Among the stocks which are not doing too well, we have GMR Infra, which is at the low point, and giving company at the low point is also Syngene. But the stock on our radar is GMM Pfaudler. It held its analyst meet and it set out a vision for 2025 where it aims to achieve 3,700 crore rupees in revenue by FY25, which would mean a compounding of 14% per year. To understand how the company plans to meet these goals, we're now joined by Tarak Patel. The stock is not doing well in today's trading session, but if you pull out the last 10-day chart or so, you will know that the street did appreciate the kind of vision that the management gave, but we do have a fair amount of questions for them as well. So as you can see, the last 1 month, the stock is up around 19 odd percent. Thanks a lot, Mr. Patel, for joining in. Current margins are around that 13% mark. You have a target of 17% by FY25. What do you think will change for the company to do that 17% margin on a much higher revenue base?
Firstly, good morning and thank you for having me. I think the two levers that we believe will help us improve our margin profile is one, obviously, in glass-lined segment, which we are the market number one. We hope to increase profitability by two levers. One is obviously operational excellence. We have two new factories, one in Germany and China, brand new, much more efficient, much smaller in terms of footprint. We expect these factories to gain more momentum and turn profitable over time. The other area is obviously value sourcing, right? So buying equipment from India, selling it into European and US market, that's a big and significant area where we believe that margins can improve. The other area for us is the service business. Service, again, they currently accounts for about 30% of our total revenue. We believe a big push in the services area, especially in India and China, can help us improve margins going forward.
All right. Hi, Tarak. A couple of questions on that parameter. Services, you said it's around 30% of your revenues?
Yes. Internationally, it's about 40%. In India and China, it's about 10 or 12%. So there's a big scope for improvement here in India and China, especially with the installed base that we have. Every quarter, every year, we
Yes.
ship about 2,000 equipment in the market. So all these equipment eventually will come back for servicing.
All right. So services as a percentage of your revenue, where does that number move to? That's point number one. And also the second factor I wanted to ask you is you get around 35-40% of your total revenues from Europe, if I'm not mistaken. There's a gas crisis out there. Isn't it hitting business, or have you sourced your gas from alternative sources, or your power consumption? Go ahead.
Yeah, so energy costs are definitely a concern, but just to kind of to give you an idea, 1/3 of our revenue comes from the US, 1/3 from Europe, and 1/3 from Asia. So Europe is about 30%. Energy costs are definitely a concern, but what's working in our favor is definitely that commodity prices have reduced, steel costs have come down. Luckily for us, the furnaces in Europe are not running on gas. They're running on electricity.
Okay.
Electricity is also seeing an upward trend, but hopefully we believe that this should start seeing some kind of cooling down in the next few quarters.
Well, that's a hope that everyone has, that there should be some sort of cooling down. But there is no visibility on that yet. Could you give us a sense of how much your European business can be hit this year itself because of this? And at the same time, with the rising energy costs, will that impact your margins? Or is there a clause that you will pass on all the increasing costs to your customers?
So I don't think we can pass on all our costs to our clients. I think there's definitely the potential to pass on most of it, but not all of it. Again, like I said, we've already put in measures to make sure that our costs are under control. So we are looking at maybe longer working days, maybe one day off. But luckily for us, the German and the UK facility, even though they have been hit by the energy costs increases over the last few quarters, we haven't seen a big reduction in profitability.
So with all of this,
yeah.
so with all of this, what does it mean for this year itself? We have your 2025 vision, but this year, with the kind of dynamics that we're seeing in the world, last year you did about 2,500 crores of top line with 11% margins. Do you have a sense of what this year can be with the potential risks?
So I think with the order book that we have on hand, we still expect to grow. We don't expect a big change in terms of guidance. And like I said in the analyst meet a few days ago, if we do track towards 17%, we will have to see some improvement. The European business is around the 10-12% mark, so we don't see a big reduction there. There could be a short-term impact due to higher energy costs, but I don't think that's going to have a big impact in this year's performance.
All right. And you're adding capacities, as you said, the new facilities you have, I think, in Germany as well as in China. So at peak levels, what kind of revenue potential do you have? And also, if you could give us a sense, you've mentioned numerous times that in the segment that you're operating in, you're the number one player. Give us an updated market share, and where does that move to in the segments you operate?
Yeah, so glass-lined business, I would say we have a market share at about 40% internationally, a little bit more here in India, closer to 50%. So we are by far the biggest the company in terms of glass-lined. I think we are 50% bigger than the competitors. So significant size and scale here. We have added capacity, like you rightly said. Germany and China are definitely doing much better than what they were doing a few years ago. In India, we've added new furnaces. In Brazil, we've added new furnaces. We just acquired a company in the southern part of the US, where we've also added glass lining the capacity for servicing. So we are looking at M&A as an opportunity to really grow the business. And like I said, services, again, is an important part of our business. So that's really where we want to be closer to our clients, to our customers, so we can be much quicker and faster in terms of response time.
Tarak, very quickly, what is your revenue potential?
So revenue potential, so when we do say 3,700 crores, this is really organic growth without, and we still kind of expect the M&A to kind of add to that. So 3,700 is purely based on what we currently have.
And that's the peak revenue potential? That's the peak revenue potential with all this current capex that you're doing? Peak is the 3,700, or you could do maybe 4,000 crores by 2025, but you're saying that, you'll achieve 3,700, or is it peak level?
So I think peak level, like you said, is around 3,700 with no more investments. But, obviously there could be a change in the product mix, pricing and things like that, which impacted, probably northwards a little bit, but, you can take 3,700 as the full capacity. Yeah.
Could you give us a sense of how big in that will your non-glass line segment be?
So that's a good question. And I think we are moving away, like I said, market share of 40% glass line, gaining market share, this stuff, and it will come at a cost. So we do believe that the revenue growth levers are really the non-glass line business where we have lower market share. So by the end of maybe 2025, we believe services and systems and non-glass line business would account for nearly more than 50% of our total revenue. And that's what we are planning to do.
Final question then. When are you increasing your stake in GMM International? Is that on the cards? And how does that change the overall things for the company in terms of shareholding pattern, if at all?
Yeah, so in 2020, we bought 54% of the international business. Just a month ago, we announced the balance acquisition of the 46%, being a related party transaction. The minority shareholders already did vote on this, and it's approved now. So maybe in the next 2 or 3 weeks, we will complete the acquisition based on some UK kind of filing requirements. But that's pretty much done now. So India is now owning 100% of the international business, full flow through of profitability, and that structure has been cleaned up and make it, just they make it simple for everybody now.
Okay, all right, Tarak, thanks so much for stopping by and filling us in with your quick uptake on business. You didn't give us a near-term revenue growth, but you've given us a 2025 vision. We look forward to chatting up with you rather soon.
Thank you.
For the time being, let's shift focus to our special segment where we get you a few ideas of profit from Money Control Pro. Madhu joins in to talk about a stock that is tracking very, very closely. Madhu?
ICICI Bank has been one of our high conviction picks from the midcap banking space, and the stock had a good run, posted strong earnings in the first quarter. The bank has been witnessing improving asset quality with negative net slippage and guiding to benign credit cost. Growth is picking up with advances growing by year-on-year 14% in the last reported quarter, and the bank is confident of growing advances by over 15% in FY23. ICICI Bank also has a retail-centric, stable deposit base and witnessing expansion in interest margin, riding on falling cost of deposits. With steady improvement in return on assets, along with an undemanding valuation, despite the stock's recent surge, we see strong upside and therefore a stock to add on decline.
Madhu, thanks a lot for that. On the other side of the short break that we're going to take right now, you don't go anywhere because we have with us the management of Garden Reach Shipbuilders. The defense stocks have been in focus. What is the potential? We have with us PR Hari, who's the CMD of the company, joining in.
Well, defense stocks have been moving up, and there's a lot of excitement out there that there could be more focus on local procurement, local manufacturing of this, and in fact, plenty of orders coming in as well. So to understand what's going on in that space, and one stock that's been in focus is Garden Reach Shipbuilders. Well, the stock has been moving higher. Today, it's more or less flattish. It's down close to around 2% odd. But you pull up a last 1 month chart, you'll see that the street has been quite excited. So to understand what's going on, we're joined by Mr. PR Hari, the CMD of the company. Hi, Mr. Hari. Good speaking to you. Thanks so much for speaking to us here on CNBC-TV18. Well, let's get some of those basics out of the way first. What is the KL capacity of GRSE? And if you could tell us what is the outfit capacity? What I'm trying to understand is what is the current capacity utilization level that you're working at?
Good morning, Nigel and Mangalam. Before I answer your question, let me just inform you and the viewers that we have started off on a very positive note during the current financial year, that is FY23. And the Q1 results have been very, very encouraging, with our revenue from operations moving up by over 90%, that is from 304 crores to 580 crores, if you compare with the Q1 of last year. And also the PAT going up from 21 crores to 50 crores, registering a growth of 143%, and our operating profit going up fivefold to 23.39 crores. So it has been very, very optimistic beginning for us, and I'm very confident that we'll be able to sustain the growth during the current financial year.
Mr. Hari,
now to answer
go ahead, sir.
To answer your question, as regards the potential that is available, both the Indian Navy and the Indian Coast Guard are major customers in the domestic warship building sector. They are aspiring to be 200 ship strong fleet by 2025 and 27 respectively. So the opportunities are galore. On a positive note, the Defence Acquisition Council approved procurement worth 76,000 crores on June 6th, of which 36,000 crores pertain to an order for next generation corvettes for the Indian Navy. Again in July 26, the Defence Acquisition Council approved procurement worth over
Mr. Hari,
27,000.
Mr.
Yes.
Hari, some of those details with regard to the Defence Council improvement and, a couple of other details, we already have with us. We want to understand what is the big opportunity for your company because, a lot of the shareholders, they are listening into you. So they would like to know more. So if you could give us basic details, your capacity, how many vessels can you work on at one point of time and your current utilization levels? Go ahead.
See, presently we have a capacity to build 20 ships concurrently.
Okay.
That is 20 warships, 8 large and 12 small or medium size. And our current order book is for 23 platforms. 23 platforms comprising of 3 projects for the Indian Navy. That is 3 P-17 Alpha stealth frigates, 8 anti-submarine warfare shallow water crafts, and 4 survey vessel large. This comes to 15 platforms.
Right.
And these are at various stages of construction. Some of them are at the pre-launch phase, some of them at the post-launch phase. So capacity-wise, there are no constraints. As far as capacity utilization is concerned, on the shipbuilding front, around 80% of our capacity is presently occupied. Now, once these ships, like 3 of these projects are expected to be of the 7 projects that we are executing, both for the Navy, the Coast Guard, and 2 export orders. 3 of these projects are expected to be completed during the current financial year itself.
Right.
So capacity.
Right.
Capacity-wise, there is no constraint.
We understand that 26,000 crore worth order backlog is what you have right now. Can you give us a sense of when does that get executed of, the orders that you just spoke about, 4 survey vessels, the vessels of P-17A frigates, etc., anti-submarines. How much of them will be delivered this year itself? The reason why I ask you this is primarily because, over the last couple of years, your asset turnover ratio has declined from 3 to about 1. So at peak levels, what is the kind of revenue you can do and what is the execution pipeline that you have?
Okay. As you rightly said, our current order book position to be exact as of 30th June is 23,583 crores. This comprises of 7 projects. Of this, we will be completing the survey vessel project by FY24, the P-17 Alpha project by FY27, and the anti-submarine warfare shallow watercraft project by FY26. Among the smaller projects, there is 1 project for the Indian Coast Guard, a fast patrol vessel, and 2 projects, 1 for the government of Bangladesh and 1 for the Cooperative Republic of Guyana, will be completing during the current financial year itself.
Okay, all right. Mr. Hari, one complaint that we have got from the street is you all are very conservative. So they would like to know, they know there's huge potential out there, but let's get a couple of numbers going then. When you're sitting on an order book of close to 24,000 crores odd, when can you hit 5,000 crores? FY24, can you do it? And also, what should be the margins? I believe you work on a cost-plus basis. So if you could tell us, what is the targeted margin?
Okay, first, you rightly said we are sitting on an order book of around 24,000 crores, and I mentioned the execution plan and the timelines for execution. So we expect our peak revenue generation during the financial years FY23, 24, and 25, with FY25 being the highest revenue earner in terms of the financial year. As far as the margins are concerned, to answer your question, we are not having cost-plus projects at all.
Oh.
We are not having that. It's a misnomer. Cost-plus projects were a norm in earlier times, but now we are competing with private players. To put you in the right perspective, both the ASW shallow water craft and the survey vessel large projects have been won on competitive bidding. Right. The margins are thin. In shipbuilding, normally the profit margins, there's a PAT margin, ranges over around 7.5%, which is a healthy margin. As far as my shipyard is concerned, we've always been maintaining a margin above this. And we're very confident through internal efficiency measures and process improvement, we'll be able to maintain margins above this. That is our assurance to the investors.
You take that point. Over the last few years, you have done double-digit PAT margins as well. Just wanted a sense on a couple of things. You said your peak revenue year will be in FY25. What would that number be? Will that be closer to that 5,000 crore mark, as Nigel said? And will we see double-digit EBITDA margins as well? Because I have a brokerage note which anticipates almost 3,000 crore revenues by FY24 with about 9 to 10% EBITDA margins as well. That is point number 1. And secondly, What the street is also building their hopes on is higher revenue coming in from portable bridges and ship repair, which is currently about 10% to go all the way up to 30%. On both of them, what is your comment? So the first one is the quantifiable number that you can do by FY25, and the second one, the revenues that you can achieve from shipbuilding and ship repair, portable bridges and ship repair.
Okay, thank you. And now coming to the revenue. Our revenue from operations was around 1,130 crores during FY21, and we had kept an internal target based on the project execution plan for a quadruple growth, that is 4 times growth by FY25. We are very confident of achieving this, and we are moving in the right direction. I'm answering your question indirectly. Our revenue is on an upward trajectory. FY23, 24, 25, you can expect peak revenues with FY25, where we'll be able to meet our internal goal of quadrupling the growth of, revenue from FY21. That is around 5,000. Now,
take that
coming
point,
to the EBITDA margins,
growth from FY21 levels from 5,000 crores. Not only is your revenue in upward trajectory, even as your stock is as well. 75% gains is what we've seen in just the last 12 months, most of them coming by in just the last 6 months. Thanks a lot, Mr. Hari, for joining in. With that, we'll take a short break. On the other side, we get you more on the markets as well as individual stocks. Welcome back. The markets in fine fettle right now, almost 100 points on the Nifty. We have the Nifty Bank sitting the gain of 400 points, and a lot of these broader market stocks doing extremely well. Patanjali Foods, the erstwhile Ruchi Soya, has hit 50,000 crores in terms of a market cap, and that stock moves higher at the high point of trade as we speak. Opened well and continues to do well as well. Kolte Patil is the other one from the real estate pack, which is up almost 7.5% at the high point as well. So looking good. What we'll do is take your break here on Chartbusters, take your leave, come back on the other side. We have the team of Trading Hour on, taking the market forward.